Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, we find out why Joye from Coolabah Capital is tipping such a big fall in house prices going forward. Dan Annan, the CEO of Cosmos Asset Management, that has a whole lot of cryptocurrency ETFs listed on the Australian stock market. He's on the show and I ask him, how scared is he about cryptocurrency's price? Where's it going to go? As you might be not surprised, he's positive on it going up in the future, but how long will that future take to arrive? And then buyer's agent Lloyd Edge from Oz Property Professionals looks at the property market right now as a buyer's agent. What are buyers thinking about the market right now? But also he explains how he's accumulated 18 properties over not a great period of time. That's the show for tonight. Let's kick off now with Joye of Coolabah Capital. Well, joining me now is Joye from Coolabah Capital. Chris, thanks for coming on the program.
Thank you, mate.
Now, I know you don't like to be on the cutting edge of doomsday merchant predictions, but you're figuring from your team, your pointy-headed team of smart people, think that house prices could fall by 30%. That was something you said in my program at least probably 2 months ago, and now more people are kind of accepting that you could be right. How certain are you about the 30% fall? Could it be 20%?
Yeah, so 30% is actually not our forecast. Our forecast is 15 to 25%. We published that forecast in the AFR in October last year, and we were very explicit. We said we thought the RBA could start raising rates in mid-22. As you know, they first hiked in May. And we said, Peter, that after the first 100 basis points of hikes, we thought house prices would thereafter adjust down 15 to 25%. The RBA's housing model, which we've replicated and we use internally, that does point to larger price falls if the RBA meets the market expectation for hikes, which is an RBA cash rate of 4% or more. And we don't think the RBA will get there. We think the RBA will probably conk out in terms of hikes, somewhere between 1.5% and 2.5%. The risk is the RBA goes heavy and hard early. So the market thinks they'll hike by 50 bips next Tuesday. And they may find that they front-end load too many hikes and the impact on the economy is quite materially negative. And we're seeing this in the data. So, and also just one point of precision, in October last year, we said we thought house prices would continue to increase by at least another 5%. They ended up rising 5.4%.
Big miss, Chris. There's a big miss.
Yeah, thanks, mate. But we are, one thing that has, I guess, surprised me a little is notwithstanding, I mean, we were very bullish, as you remember, on housing pre-pandemic and post-pandemic. But we were definitely the first sort of mainstream analyst to turn very bearish late last year. But we have seen house prices react very quickly. So the national index has fallen for 2 months in a row over May and June. House prices in June in Sydney fell by 1.6% in that month alone. And in Melbourne, they fell by 1.1%. That may not sound like much, but Sydney and Melbourne house prices are right now falling at a double-digit annual pace. And we're also seeing house prices in Brisbane start to roll over. And we're seeing prices in Perth begin to flatline. So I am very confident that house prices will fall 15 to 25% if and only if the RBA hikes by at least 100 basis points. It looks like the RBA will definitely do that. So, barring some sort of ultra aggressive intervention by governments to bail out the housing market, we're going to have a big drawdown. But we have seen significant drawdowns in 2008, between 2010 and 2012. And then national prices actually fell 10 to 11% between 2017 and 19, when APRA basically made it much tougher for banks to lend against homes. And you might remember in 2015, 16, 17, banks really aggressively jacked up the borrowing rates on loans to property investors. So there was a huge increase in investment interest rates. And that's what precipitated what was a record loss for the housing market of 10 to 11% between 17 and 19. And I think a 15 percentage point fall in prices is all but inevitable. When we said this in October last year, nobody was forecasting it. I think it's important that most of the big banks have embraced this perspective and are now calling similar falls. The 30 to 40% fall that we talked about recently, mate, was really predicated on the RBA lifting the cash rate to above 4%, and we don't think they're going to do that.
Okay. Okay. Your inflation forecasting, Chris. Now, the Reserve Bank thinks it could get as high as 7%. Now, I know you will be trying to work out the inflation forecasting model. What have you guys come up with?
Mate, I suspect you're glass half full on this, and captured by a bit of hopium in the inflation. On the inflation front.
Surprising you'd say that about me, Chris, but go on.
Well, in our conversations, you tend to be more glass half full. But what I would say is that I think that there is some early evidence that inflation is indeed starting to roll over in core global markets. So we've actually seen some weaker inflation prints in Europe, and I think this is very important. And then in the US, we've had 3 or 4 core inflation prints using the Federal Reserve's preferred inflation measure. It's called the core PCE measure. No need to really understand that point. It's just a particular inflation index. But that index printed overnight, and the result was weaker than the market thought. And it sort of confirms that US inflation, core or underlying inflation, has come down from using this particular index, a 5 to 6% level, down to a 3 to 4% level, and it's starting to roll over. We're also seeing signs in the US that wages growth is starting to attenuate. And obviously, there have been a huge conga line of supply side shocks that have pushed up inflation. But as the governor of the RBA said, unless oil prices increase by another 66%, if they just simply stay at the same level, that is the price of oil, then there will be zero inflation in the price of that particular commodity. So I think that there are good reasons to think that inflation rates globally and eventually in Australia, because it does feel like we're a little bit behind the US in terms of our own inflation pulse, those inflation rates will start rolling over as producers supply more of the goods and services that they were not able to supply during the COVID lockdowns. And then, obviously we have the Russian and Ukrainian conflict, and then the Chinese lockdowns to contend with. So there have been a sequence of supply side shocks that have artificially increased inflation rates, but they have been amplified by very strong demand. So global growth has been strong. Unemployment rates globally have been very, very low, including here in Australia, and that has fueled wages growth. And we have had some nascent wage price spirals emerging globally, and that's been a cause for some concern. But the world has a lot of debt, and these interest rate hikes are likely to be potent. We're seeing in Australia, the housing market has reacted almost immediately. And I think the RBA is going to take very significant note on this. Now, I think it's important. One little aside, Peter, the governor of the RBA, just before he started hiking, started talking about the need to get back to neutral and normalize the RBA's overnight cash rate, which is the cash rate they set, and then our bank deposit rates and home loan rates price off that. And he was frequently referring to getting that cash rate to 2.5%, which he thought would be normal. But a 2.5% cash rate would really have quite deleterious consequences for things like the housing market, for consumer confidence, for construction and associated sort of employment sectors. And he had also acknowledged that the RBA had a horrible forecasting track record and had completely got the pre and post-pandemic periods totally wrong. And so we sort of questioned, if you're telling us you can't forecast your next footstep, how do you know you're going to get to a 2.5% cash rate? Because that's a long, long way away from a 0.1% cash rate. And I think it's encouraging, mate, that in his last speech, he really was at pains to say, we are not targeting a specific endpoint or a specific cash rate. He seems to have walked back a bit from the 2.5%. And then he stressed, mate, that they're going to watch like a hawk household spending. And I think that's key because consumer confidence is very weak right now. It's going to weaken further. And I think that this record correction in the value of households' most important asset is inevitably going to bleed into sentiment, spending, and ultimately economic growth. And it's something the RBA needs to pay attention to.
Yeah, and also, Chris, there's two things I like to say about Dr. Lowe. One is that we all thought he was being ridiculous, saying that interest rates wouldn't move to 2024. But when he was saying it, the economy needed to hear it. It was right at the depth of the coronavirus crash. So it was a smart thing to say, even though people like you and I never ever thought he would hold it to it. Now he's saying stuff like you were saying. He may well be jawboning big time, so he doesn't have to actually raise. And we are seeing it, aren't we? We're seeing consumers, business confidence starting to fall. So maybe he, in the fullness of time, someone might say he made some what seemed to be dumb comments, but they worked in terms of not making interest rates go too high. And one other thing, I'm sure he must be looking at these petrol prices and saying to himself, well, these are like interest rate rises. I know I filled my car up the other day, and it used to be a 120 fill. Now it was 183, and that's $63 extra a week. And that's like an interest rate rise, isn't it?
Yeah, I totally agree. And I think you made a very nuanced and interesting point, because what you're really saying is that he's using this so-called jawboning technique to verbally deliver some come to Jesus moments for the economy. Now, back in the pandemic, he needed to deliver a message of assurance, safety, security, stability. Now he needs to deliver a little bit of shock value to say, hey, you can't just unilaterally increase wages by 5% to track a one-off increase in inflation, and you need to be insured. He needs to really kind of snuff out any prospect of a burgeoning wage price spiral. And I think, there's a lot of merit to what you say, mate. There is a lot of merit. But having said that, the counter-argument perhaps is that he did encourage, hundreds of thousands of Australians to take out a lot of debt on the presumption that they wouldn't see rate hikes for a long, long time. Even as recently as late last year, he more or less roundly dismissed the possibility of hikes in 2022. And now he's suddenly telling us, he needs to get to 2.5% as quickly as he can. I think the management of the communications and the management of policy was suboptimal and could have been improved. But the one thing I've said about the RBA, these guys are very smart, they're very hardworking, they're very passionate about their jobs. But like all of us, they're not infallible. There is a review that's about to start of the RBA and its policy choices to try and determine whether they could have done a better job. And I'm sure they'll find that there's opportunities for reform.
At a time when cryptocurrencies are in a bit of a crisis, with the stock market sell-off not really helping the cryptocurrency world, we've got Dan Annan, who's the Chief Executive Officer at Cosmos Asset Management, and they've recently listed a number of ETFs linked to cryptocurrency. We'll see how that's going and what he's expecting will happen in the future. Dan, thanks for joining us.
Oh, thank you very much for having me. It's always a pleasure.
Wow. So Dan, I guess you would have preferred this not to happen when you've just kicked off some new ETFs.
Look, precisely, right? No one, you can't, one of the things as issuers, you can't time the markets, right? Our goal at Cosmos Asset Management was to deliver access to the cryptocurrency asset class on the regulated financial platform. And that's what the exchange traded ETF brings to the table for financial professionals that want to be able to hold the asset within portfolios. And the key for us is that we've got the products out the door, and the next step is really getting investors to really understand the fundamentals of the asset class. So no, ideally you want to launch product when markets are calm, but we've launched in I would say global volatility market, including fears of inflation, recession, and a crypto winter. So timing is not great, but we're steadfast and we'll continue to educate the market.
I would presume that inexperienced investors may well have left the market, while maybe experienced ones see this as a buying opportunity.
Well, precisely, right? I mean, I think I'm often asked when I'm talking to investors around the asset class, like, where is the bottom? And my response is that where is the bottom is the wrong question. What is your investment objective? One, two, what is your view of the cryptocurrency asset class, especially the blue chips? And is the current position or the current valuation of the asset class, will that remain the same relative to the future? And our view is, if you look at the fundamentals of Bitcoin and fundamentals of Ethereum, what we continue to see is continuous adoption, specifically with Bitcoin, continuing adoptions of individuals, holding the asset class. That's measured by new addresses that's being published, right? And so those are the fundamentals of how you value the asset. And then what's really different to the current environment we're in, to the previous volatility we've seen in crypto, the difference between today and what we've seen in the past is we actually have quite a bit of institutional adoption and institutional investors looking at the asset class overall, not specific to just Bitcoin or Ethereum, but also the infrastructure around it. And we're seeing businesses either acquire certain businesses that have been caught up in the crypto winter to bolster up their business because they want to enter into the cryptocurrency infrastructure. So, while we are in what I would call a crypto winter, what's really, really interesting to see is that you're seeing institutional investors like JP Morgan, Goldman Sachs, among others, investing or looking at the asset class differently and looking at different businesses for which they can acquire to bring onto their platform.
Has the business model and the expectations about the business model for you been negatively affected by the fact that some really well-known cryptocurrency platforms and exchanges look to be in trouble, or there's question marks about their solvency? Is that something that, once again, is a headwind that you have to deal with?
Yeah, certainly. I mean, it's a headwind that, I think if we look at the tech sector back in the early 90s, it's a headwind that the tech sector also have to deal with, right? Certainly, there are businesses that have put on leverage positions in a time of zero interest rates, and that's going to move against them, right? And so you will see some businesses survive, you'll see some businesses fail. And that's okay, right? And that's why we have capital markets. I mean, the key is that investors should really be thinking about the fundamentals of the asset class, looking at the blue chips of this asset class, specifically when we talk about cryptocurrency, Bitcoin, Ethereum. What are the fundamentals for Bitcoin? What does it stand for? What is it supposed to do? Ethereum, similar. Ethereum is really, really interesting from my perspective, is that it's going to be the platform where a lot of traditional businesses bring on as a way to manage logistics. And Ether, which is the crypto coin or token that is used to transact within the Ethereum platform, that's what's used. So investors that have a view that you have businesses, global national businesses, that are adopting or looking at the Ethereum platform to manage logistics for the future should be thinking about Ether as a way to gain exposure to the future growth of that token. And for Bitcoin, really, as I mentioned earlier on, it's about the adoption rate of individuals that are getting involved, as well as globally, some of the emerging countries that are starting to look at it as a way of holding as part of their treasury. And look, while it's early days, would you have rather bought Bitcoin when it was at 60 or when it's at 20? Right? And so you have to have a long-term view of this asset class.
I would have preferred it at 250 rather than all those numbers.
Yeah, precisely, right? So look, we're so early. I mean, we think about where we are in the cycle of cryptocurrency and sort of where we go. We're so early in its infancy, right? That the opportunity is there. I think investors need to get really comfortable around, how to allocate the asset within a portfolio construction. And our view, between 2 to 3% of an allocation of a 60-40 portfolio should do the trick, depending on each individual's risk profile. And you've got to think about dollar cost averaging into entering into positions, and not sit on the sidelines. Because if you sit on the sidelines, Peter, you'll be saying the same thing, or someone else will be saying the same thing in a couple of years, like, oh, I should have gotten at 20 instead of waiting where it is, whatever that price point is in the future.
Dan, anyone who is already in your ETF or thinking about it would be asking the question, how safe is it? Now, clearly, if the price falls, it's risky, but all investments are like that. But how can people be sure that the structure you've got behind this ETF is rock solid, so I can make sure I can transact, sell, buy, and make a profit if a profit's there to be made?
Yeah, look, that's a great question. I think there's two things to that question. The first is our partnership with Purpose Investments. Our JV with Purpose Investments is what basically keeps us solid during this crypto winter, right? So Purpose Investments is a Canadian fund manager who launched the first Bitcoin and Ether ETFs in the world out of Canada. 14 billion fund manager, strong balance sheet, and they are our JV in delivering these asset classes to investors. That's one. The second thing is, if you look at the underlying market cap of both products, well over, or both exposures are both well over $100 million in FUM. So, investors that buy into CPET, which is the Cosmos Purpose Ethereum ETF, what they're doing is gaining exposure of the Toronto-based listed Ether ETF. And investors who buy CBTC, what they're doing is getting exposure to the Toronto-based listed ETF. And all we're doing is just giving them that exposure through the local listed ETF in Australia.
Okay.
Further to that, we have strong market makers that are there on screens to ensure fair pricing for investors to buy in and out. So the investor experience really is when Bitcoin goes up, and if you own CBTC, your exposure or your pricing goes up with it. And as a manager, the key is to ensure that we are actually doing our job in tracking the index.
Okay. Last question, mate. Obviously, you be thinking about cryptocurrencies night and day at the moment. What do you think is going to happen? What's going to play out over the next 6 months for cryptocurrency, and why?
Yeah, look, I think the key is that you're going to see the volatility that we're seeing now is going to persist with central banks' movements of rates. That's going to impact businesses that are leveraged in this space, right? So you've got a volatile asset class one, and you have positions on that are leveraged. That's going to hurt some businesses. So I think what we will see here is sort of a clean out or a washout of some of the unstable businesses in the asset class, and you'll see the cream rise to the top. But when we look at the tokens themselves, I think when you look at the fundamentals of Ethereum and the applications of Ethereum and the Ether token within that blockchain technology, that's going to stay. That's a blue chip stock within the cryptocurrency token, and so is Bitcoin. So I think, what we'll see in the future is, some of these stable coins or higher market cap blue chip tokens will sort of work their way through this difficult time period. And then investors that stick with it would be the winners in the long term.
One final one, the old view was that maybe Bitcoin has a high correlation with gold, but it seems like Bitcoin and cryptocurrency really has a high correlation with tech stocks. Therefore, if you believe tech stocks will rebound later this year, you then would keep your fingers crossed that correlation would actually bear fruit again.
Look, yes to some extent. I think, what we saw with the high correlation of crypto to tech stocks is you saw free cash flow or speculative cash flow chasing high risk assets, high risk, high reward assets, and that's tech and that's crypto. And we've seen sort of the correction correlate back on the way back down. I think, yes, there is some component of crypto to tech. It is a technology, it's a blockchain technology. So investors with that view for the blockchain technology certainly should have, I would say first do your homework to ensure that the exposure they're taking on is the type of risk they want to take on for the long term. But you should see some sort of, the correlation of tech to crypto should persist.
Dan, thanks for joining us. Good luck.
Thank you.
Dan Annan from Cosmos Asset Management. Well, joining me now is Lloyd Edge from Oz Property Professionals. And I want to see what he's seeing out there in the market as a buyer's agent. I also want to work out how he ended up with 18 properties. Let's just see what his buying technique has been. How are you, mate? Nice to meet you.
Very, very well, Peter. And yeah, great to be with you.
So tell us about, as a buyer's agent, obviously over the last 2 or 3 years, there's been plenty of business because there's been plenty of buying. What are you seeing right now?
Right now, what I'm seeing is the markets in the capital cities, particularly Sydney and Melbourne, starting to slow down a little bit. Auction clearance rates coming down, a lot more vendors and agents willing to actually accept offers before auction, which is unusual. Certainly in a hot market, you don't really get that much. So we are getting more opportunities to to put in those offers pre-auction. What I'm seeing in some of the regional markets, they're quite strong though, and particularly for investors, the rental yields are still quite high, and there's still sea change and things. People are still moving to some of those regional markets, so they're quite strong across the country at the moment. So there's several different property markets still occurring.
Yeah. So this whole idea of working from home and using Zoom or Microsoft Teams and things like that, has that really helped the regional property markets?
Yeah, I think it has. I think there's been quite a lot of people that have actually made the move from the cities. They've moved into these regional markets. People have been moving there for more space, get larger homes, get an office space there, where maybe in the city they can only afford to have an apartment, where you can buy a much larger home with some acreage, bring up their kids. And I think that's really been driving these regional markets. So I think it's definitely had an impact, and I'm seeing that across several different states as well, because we buy across all the eastern seaboard.
So does that mean that there's potentially value in the apartment market because people are leaving, or does the number of people coming into the market, either it be by migration or younger people trying to escape their parents and grow up and get into an apartment, is that not necessarily showing up as apartments are becoming really good value at the moment?
I actually think there is some value coming back into the apartment market now, but not so much one bedrooms. I think one bedroom's a little bit out now because they just don't have enough room. I think two bedders plus an office space are the ones that are coming into flavour. Yeah. And I think for young couples and people just moving out of home trying to get into the market, there's definitely some opportunities there and some good buying at the moment.
Mm. You were talking about offers before auction. What's actually going on there now? Are potential buyers saying, I'd rather wait to see the auction and get a good bargain at the auction rather than trying to get in before an auction and get a good price?
Yeah, so that sort of depends. It really depends on the property and on the agents. So with me, I work with a lot of buyers, and I sort of try to suss out the vendors, the agents, why they're selling, how much interest they've had in the property and everything like that. We've still got vendors out there who insist on going to auction and everything. It really depends on if you can put in an offer and it's quite a reasonable offer. Quite often when you put in an offer before auction, you need to put your best foot forward, and it needs to be quite a strong offer. Otherwise they won't consider it. What I'm seeing at the moment is them considering much more reasonable offers. So, if you get a lower offer accepted, then that's great. But if you don't really get the price you're looking for, then you'll hold off and go to auction. So I think what I'm kind of seeing is that buyers are willing to put in an offer, but if it's not for the price they want, then they might still, go ahead and do the auction.
Okay, we have a colleague who has a very nice property overlooking the harbour in Sydney, and an agent that won the business thought it'd be an $11 million property. Other agents did tip 8 or 9, but of course she went with the agent tipping the most. But at this point in time, she's not getting an offer even in the 9s. Is that because the high-end property market is actually coming off the boil faster than the more accessible markets?
It is. So the higher end markets tend to come off a little bit quicker because there's limited buyers in that market. So if you look at the lower to medium sort of priced properties, there's much more people there in demand there, and first home buyers and stuff for particularly sub 1 million and sub 1.5, depending on what markets we're looking in. But if you're looking at properties at 5 million plus, 10 mil plus, there's much more limited buyers there. And they'll be even more limited and wanting to get more of a bargain. So those are the markets that tend to come off. I think the other thing also is that I'm always wary of real estate agents that are suggesting too high a price that you can sell a property for. I'm often be tempted to go with the one that might be offering that lower price because it might be more realistic anyway.
A person in that sort of situation, would you advise them to go to auction, or is it risky to go in auction and get no bids at all?
With those sort of properties, I'd probably want to work with an agent that can actually find a good buyer, and probably not go to auction, because there's going to be probably limited people come to auction on a property like that, particularly in the current market. So I'd be wanting a good agent who can find a realistic buyer. That's probably the position that I'd be in the current market. When you're in a really hot market, it's different. You're going to have a lot of buyers. So it really just depends on the market you're in. But where we are at the moment, I'd be wanting to get an offer and get some qualified buyers. Okay,
because you work with buyers, you should be able to gauge what kind of reaction people are having to the increasing interest rates. Are they dropping out? Are some dropping out of the market altogether, or are they just downgrading what they're prepared to pay?
Yeah, so there's a little bit of both, and a lot of that has to do with the borrowing capacity, because as interest rates go up, people can actually borrow less money, unfortunately, so that does affect what they can buy. And then it depends on, if you're looking as a homeowner or an investor. So I'm finding that a lot of my investor clients are just really looking for much more positive cash flow, which is something that I focus on after I did write a book called Positively Geared. So I do focus on that positively cash flow type property for investors. With homeowners, I find that people are starting to look in that lower price brackets, or just wait a little bit longer. A lot of them are sort of looking to see what might happen in 3 to 6 months' time, to see if the market's going to drop more or stabilise.
How far do you think prices will fall?
I'm thinking probably around 15 to 18% in the Sydney and the Melbourne markets. Yeah. I think we're probably going to see some big price reductions also in Brisbane, because it was a very overheated market last year. And I think there's a lot of FOMO, people paid too much. So while there's still a bit of strength in that market, I think that's going to probably come back probably 10 to 12%. Adelaide was also very heated, and the agents are telling me in Adelaide that it's really starting to slow down there, and they're not making a lot of sales there at the moment. So I probably think maybe 10% back there at the moment. Okay. And I think the regional markets are still quite strong at the moment.
Okay, in one of your press releases, you make the point that you own 18 properties, and a lot of people do warn young people who aspire to copy people like you, that it can be dangerous. How have you done it? Did you make mistakes in your early days? And what have you learnt from those mistakes?
Well, I've certainly made plenty of mistakes, and I don't think anyone who's been successful at something hasn't made mistakes. But the other thing I should also point out that it is trickier these days to keep building a portfolio with finance than what it was when I first started as well. You can still do it, but maybe not to the same extent. But what I was always focused on was the cheaper price points. So not spending too much, always looking at under my borrowing capacity and looking at positively geared properties. So trying to get good cash flow there. One of the mistakes I did make once was buying in a mining town because it had really high yields. Where I bought a property for 260,000, it was renting for 800 a week, and then suddenly the mining boom sort of ended overnight, and that property just went back overnight, and suddenly was renting for 180 a week, and I've actually still got that property. So that was a major mistake. Good learning experience to share with people. So definitely made some mistakes there, but the main thing that I think I can probably share with people is that it's really important to look at the capital growth you're going to get in the properties, because that's what's going to create the wealth, not so much the rental yield. And one of the things that I've always done to grow my portfolio is to diversify amongst different lenders. And I've never been scared to use non-bank lenders. So not just the major four, but the non-bank lenders that have higher serviceability calculators, and diversifying across different locations as well.
Great stuff. Lloyd, thanks for joining us, and good luck going forward.
Thanks so much, Peter.
Lloyd Edge from Oz Property Professionals. And that's the show for tonight. Thanks for joining us. I'll see you on Monday. If you want to know more about what we do, or you're looking for more insights into stocks to buy or sell, have a look at switzerreport.com.au. Thanks for joining us. See you on Monday.